In the last 12 months, a payment system most people have never heard of quietly recorded the equivalent of 180 trillion renminbi in annual business volume. That's not a typo, 180 trillion. And while you were watching the dollar index move 1% here and 1% there, the pipes underneath global trade were being rerouted. Not months, not weeks. In 48 hours, a single corridor can change where liquidity shows up, which banks touch a trade, which regulators see it, and what collateral gets posted. They told you the dollar system is too big to shift. They said it could never happen without a headline crisis, without a visible collapse, without chaos in the streets. But the data doesn't work that way. Here's the uncomfortable truth. Institutions don't wait for a dollar collapse. They don't need the dollar to fail to reduce exposure. They change settlement first, quietly, bilaterally, operationally, one agreement, one messaging route, one clearing bank, one collateral framework at a time. And by the time the public notices, the behavior is already embedded in contracts, supply chains, and balance sheets. Because the dollar doesn't collapse first. Trade settlement changes first. Welcome to Vault Line Macro, where we track the settlement pipes before the headlines arrive. If you like analysis that focuses on the machinery of markets instead of the noise, you're in the right place. Subscribe the way you'd keep a wise elder close by, and let me know in the comments where you're watching from. Because this shift is global, and it looks different depending on your region. Now, let's talk about what actually happened. 94%, ranking at 6th. Read that again. Under 3%. If you only look at that one number, you'd conclude the story is overhyped. You'd say, see? And in many ways, it does. But that's the trap. Payments share, reserves share, invoicing share, and settlement rails are not the same layer of the system. They move at different speeds. They respond to different incentives. And right now, those layers are telling opposite stories. On the surface, trade invoicing remains concentrated. The dollar and the euro together still account for over 80% of global trade invoicing. That means most invoices are still written in the legacy currencies because pricing conventions, commodity benchmarks, and corporate treasury habits change slowly. If you ship a container of goods, the invoice language is often the last thing that gets rewritten. Yet underneath that invoice, the settlement route can change without rewriting the invoice at all. And that is the crisis unveiled. Because when settlement routes shift, the dollar can remain the language of the invoice while losing its monopoly as the pathway of completion. It's the difference between what's written on paper and what happens in the plumbing. The world can keep saying dollar while doing less business through the dollar's pipes. Here's where it gets interesting. 99% in the second quarter. Again, tiny. Barely a sliver. So if reserves are the scoreboard, the dollar looks unbeatable. But reserves are a lagging indicator. Reserves are what central banks publicly hold after decades of habit, policy, and market depth have built trust. Settlement is what happens daily in real time when a buyer and seller decide which bank, which corridor, and which legal framework they're comfortable using this week. And this is exactly how monetary transitions have always worked. In 1971, the United States ended gold convertibility. Trade still happened, but behavior began to change. Countries started negotiating energy pricing, recycling surpluses, and building new financial instruments to manage the new regime. The settlement and collateral ecosystem evolved first. The reserve story followed later. In the late 1980s, Japan's rise wasn't just a story of GDP. It was a story of banking networks, trade credit, and corporate cross-holdings. The yen did not replace the dollar as a reserve overnight. But settlement behavior in Asia shifted as Japanese banks became dominant in trade finance. The playbook was the same: operational influence first, symbolic dominance later. Then in 2008, when the global financial crisis hit, something else happened. The dollar didn't die. It surged because in crisis, the world runs toward the deepest pool. But that surge triggered a lesson. Countries realized that dollar funding stress is not a theory. It is a mechanical constraint. And after 2008, you saw a wave of actions designed to reduce that constraint. Central bank swap lines, regional arrangements, and alternative messaging and clearing efforts. Again, settlement resiliency first, reserves last. Now in 2026, the same pattern is happening again, but the headline watchers are looking in the wrong place. They're waiting for a dramatic collapse of the dollar's exchange rate. They're waiting for a reserve dump. But the system doesn't break like that. It reroutes. Now let me show you the players and the moves, because this is the part no one is discussing. First, there are the messaging networks and settlement rails. SWIFT is the global messaging backbone most people associate with cross-border transfers. But alongside SWIFT, there are alternatives that have been expanding quietly, designed to ensure that trade can be settled even if a corridor is restricted, monitored, or expensive. China's cross-border interbank payment system, CIPS, is one of the most watched. On its own reporting, it lists 180 trillion renminbi of annual business volume for 2025. And it lists 193 direct participants and 1,473 indirect participants. That participant growth matters because rails are only as useful as the network connected to them. A system with volume but no reach is a curiosity. A system with volume and reach is infrastructure. Second, there are bilateral settlement agreements. These are not flashy. They're not always announced with fanfare. Sometimes they are simply updates between central banks or expanded local currency settlement frameworks between trade partners. The important detail is not the press release. The important detail is that the operational option exists, ready to be used when pricing, sanctions, risk, or funding stress makes it attractive. Third, there's collateral. Settlement is not just about sending messages. It's about who trusts whose balance sheet, what collateral is accepted, how quickly liquidity can be sourced, and what happens when a trade goes wrong. This is why central bank behavior is so revealing. 3 tons of gold, 4 tons in 2024, a 21% decline year over year, but it remained historically elevated compared to the decade before. Gold in this context isn't a bet on apocalypse. It's collateral outside the political system of any single currency. It's a hedge against the rules changing mid-game. Now, put those moves side by side and notice the coordination through timing. When settlement rails expand, when bilateral frameworks multiply, and when official institutions accumulate collateral that doesn't depend on another country's liabilities, you're seeing positioning, not a declaration. Positioning. And positioning creates dislocation. That dislocation shows up in 2 sets of numbers that don't match. On one side, you have trade invoicing concentration, over 80% in dollar and euro terms. On the other side, you have expanding alternative corridors whose throughput is large enough to matter. A rail that clears 180 trillion renminbi in a year is not a rounding error. Even if the global share is small, it is big enough to provide an option. And in markets, options are power. The contradiction becomes even sharper when you compare payments share to reserves share. 94%. 93%. Those numbers are not supposed to be the same, but the gap matters. It tells you that usage can rise while official stockpiles remain cautious. It tells you the real economy can route around the official narrative. And here's why the gap cannot persist indefinitely. If settlement corridors diversify, it changes the demand for dollar liquidity at the margin. Not in a dramatic way overnight, but in a way that matters in stress events. The dollar system's strength is not just that it is used. It is that it is the default in funding markets, in collateral chains, in derivatives, and in trade finance. When a portion of trade settles outside the default pipes, the web of dollar claims grows slightly less dense. That sounds minor until you remember that crises are about margins. A small change in marginal demand can determine whether funding markets freeze or function. So what mechanism drives this? How is it executed? It's rarely a single switch. It's a sequence. Step 1 is risk perception. A firm, a bank, or a country decides that reliance on a single corridor creates vulnerability. That vulnerability could be sanctions risk, it could be settlement delays, it could be higher compliance costs, it could be sudden changes in correspondent banking relationships. The reason doesn't matter as much as the conclusion. They want an alternative. Step 2 is building the alternative. That means signing agreements, onboarding banks, integrating systems, setting standards for messaging, and creating liquidity lines. It's slow, boring work. It's also where the real transition happens. Step 3 is testing. Small trades are routed through the new corridor. Settlements are monitored. Disputes are resolved. Treasury teams update procedures. Once it works, it becomes a contingency plan. Step 4 is scale under pressure. When a shock hits, the contingency plan becomes the main route. And this can happen fast. Not months, not weeks. In 48 hours, volume can pivot if the alternative is ready. Think of it like a highway system. The old highway is the dollar corridor. It's wide, deep, and historically reliable. But if a bridge is closed, traffic doesn't stop. It reroutes to side roads. Those side roads don't replace the highway on a normal day, but they matter when the bridge is blocked. Over time, if the side roads get paved, widened, and connected, the city becomes less dependent on the original highway. That's settlement diversification. Now let's connect the dots between institutions that look unrelated. When central banks buy gold at historically high levels, they are increasing reserves that are not someone else's liability. When settlement systems like CIAPs expand their participant network, they are increasing operational capacity to move value without depending on the traditional messaging monopoly. When bilateral agreements allow trade to settle in local currencies, they reduce the need to source dollars for every transaction, even if the invoice stays in dollars for convenience. Put together, you get a world where the dollar remains the unit of account for many things, but becomes less of a choke point for completing transactions. And that is the shift that matters. Because once completion pathways diversify, it becomes harder to use the settlement system as a tool. It also becomes harder to predict where liquidity will concentrate during shocks. The market becomes less centralized. This is where the next dislocation emerges. Paper signals versus operational signals. The paper signals are the ones everyone can see. Exchange rates, reserve shares, headline swaps. The operational signals are the ones that show up in infrastructure metrics, participant counts, corridor usage, and collateral choices. The public debates the paper signals. Institutions watch the operational signals. And that's why expert commentary often sounds contradictory. One expert says, the renminbi is insignificant in reserves. Another says, alternative settlement corridors are accelerating. Both can be true at the same time because they're looking at different layers. So what does this mean forward? Historically, when settlement routes diversify while reserve composition lags, the next phase is fragmentation in pricing and risk management. Not necessarily a collapse, a fragmentation. That shows up as more currency swaps and regional trade, more hedging demand, more basis volatility between markets that used to move as one, more moments where a price in one venue doesn't match the price in another venue, because liquidity pools are less synchronized. If the current trend continues, there are three broad scenarios, and each is grounded in history, not prophecy. In a conservative scenario, settlement diversification grows, but remains mostly a contingency. The dollar stays dominant in invoicing and reserves, but alternative corridors reduce tail risk for certain countries and industries. The big change is invisible until a shock, when those corridors prevent a funding squeeze from spreading as far. In a moderate scenario, settlement diversification becomes routine for specific trade blocks. Commodities and manufactured goods in certain regions increasingly settle through non-dollar paths, even if benchmarks remain dollar-based. The result is a world where dollar funding stress still matters, but it is less universally transmitted. The system becomes more regional. In an aggressive scenario, a major geopolitical or financial event pushes a large volume of trade to permanent alternative settlement routes. The dollar does not disappear, but it loses some of its automatic role. The result is more volatility in exchange rates, more competition in payment systems, and more emphasis on collateral that is politically neutral. Notice what none of these scenarios require. None require a dramatic dollar collapse. None require hyperinflation. None require an overnight reserve dump. They require only that operational incentives continue to favor optionality. So what should you watch? If you want to understand this without getting lost in noise, watch participant growth in alternative settlement systems. A rail's importance is measured by who is connected, not just by what is promised. Watch the spread between invoicing and settlement. If invoices remain in dollars, but settlement increasingly routes elsewhere, that tells you behavior is changing even if language isn't. Watch official collateral behavior. When official institutions keep accumulating non-liability assets like gold at elevated rates, they are signaling risk management priorities. And watch moments of stress. The real test of any system is what happens when a corridor is blocked, a bank is sanctioned, or funding costs spike. In those moments, the contingency routes reveal whether they're symbolic or functional. This brings us to the divide. There are people who will keep waiting for a dollar collapse headline because that's the story they were trained to recognize. It's dramatic, it's clean, it has a villain and a climax. And there are people who will watch the settlement plumbing because that's where real transitions begin. Not because they're smarter, but because they're paying attention to the right layer. The information gap becomes a wealth gap, not through secret knowledge, but through timing. Institutions move first because they live inside the machinery. Retail moves last because they are given the story after the system is already adjusted. So the question isn't whether the dollar collapses first. The data suggests it won't. The question is whether you recognize that settlement routes can change while the dollar still looks dominant in the visible scoreboards. Dollar strength is the exchange rate and the reserve share. Dollar plumbing is the set of assumptions the world runs on. That dollar liquidity will be available on demand, that key commodities can be financed and hedged through dollar markets, and that correspondent banking routes will stay open. Settlement diversification targets the plumbing, not the headline price. That's why a central bank can keep most reserves in dollars while still supporting non-dollar settlement routes. Reserves are about deep, liquid emergency assets. Settlement routes are about day-to-day resilience. Holding the deepest pool for a crisis does not require using that pool for every transaction. Now look at who makes a corridor real. First are the correspondent and clearing banks that agree to intermediate payments and provide intraday liquidity. A corridor can exist on paper, but without banks willing to run the operational load, it doesn't scale. Second are central banks and monetary authorities that provide swap lines, local currency, facilities, or standing arrangements that keep liquidity from drying up when volumes surge. These are the hidden support beams that turn a pilot into a usable path. Third are the corporates that actually move the goods, commodity traders, shippers, and industrial conglomerates. Their decisions are usually simple. They choose the route that is cheapest, fastest, and most predictable under stress. Ideology is optional, cash flow is not. This is where the dislocation becomes concrete. On the public scoreboard, the dollar and euro still dominate invoicing, and the renminbi still looks small in SWIFT payments share and even smaller in reserves. But at the infrastructure layer, alternative rails are gaining capacity. CIPS reporting 180 trillion renminbi of annual business volume, with 193 direct and 1,573 indirect participants, is not a symbolic project. It is a network. And networks change the bargaining power of the system even when their share is small, because crises are not decided by averages. They are decided at the margin. If a portion of trade can settle without passing through the default pipes, the marginal demand for dollar funding shifts. That does not automatically weaken the dollar on a calm Tuesday. But it can change what happens when funding tightens, when a corridor is blocked, or when a bank pulls correspondent lines. A small reduction in forced demand can be the difference between a squeeze that spreads everywhere and a squeeze that stays regional. This is also why official gold buying belongs in the same story. 3 tons of gold in a single year, they are accumulating collateral that is not a liability of another government. That is not a bet on collapse. It is insurance against rules changing mid-settlement. In a world where corridors can be rerouted, politically neutral collateral becomes more valuable. Now, how does the slope become a sudden shift? The trigger is usually stress, not speeches. A funding shock makes dollars expensive for certain participants. A compliance shock makes a route unpredictable. A geopolitical shock raises the probability of delay, seizure, or forced disclosure. In those moments, contingency corridors get used at scale, and the switch can happen fast because the work was done beforehand. It's like a city adding side roads. On normal days, the highway still carries most traffic, but when a bridge closes, traffic doesn't stop. It reroutes. And after enough closures, the city stops treating side roads as optional. They become part of the standard map. That is substitution at the margin. It is how large systems change without announcing it. So when you hear de-dollarization, ignore the cliff narratives. Watch the slope. Watch who is connected. Watch which routes are tested. Watch what collateral is being accumulated. And watch what happens during the next stress event, because stress reveals which options are real. That brings us back to the core claim. The dollar doesn't collapse first. Trade settlement changes first. Quietly, incrementally, and then, when pressure hits, quickly. If settlement continues to diversify, the most likely outcome is not a single dramatic break, but fragmentation in pricing and risk management. You'll see more trades priced one way and settled another, more regional reference prices, more currency hedges that used to be nice to have becoming routine, more moments where 2 markets claim to represent the same underlying flow, yet prints diverge because liquidity is no longer concentrated in one venue. And you can measure that fragmentation without guessing. Watch the growth of clearing relationships and offshore settlement centers linked to new corridors. Watch cross-currency swap usage in the regions where trade is being rerouted. Watch whether large commodity and shipping contracts start including multiple settlement options as standard language. Those are operational tells, not opinions. Most importantly, watch the moments when everyone needs liquidity at once. The old system's advantage has always been depth under stress. If alternative corridors prove they can clear volume during stress without relying on the same dollar backstop, then the invisible layer will keep compounding until the visible scoreboards finally move, long after the transition began. That's why the biggest signal isn't a speech or a chart on television. It's a quiet procedural change, a new counterparty approved, a new corridor tested, a new default chosen in the background.